EBITDA is an important metric for investors because it allows investors to see how much money a company is generating from its primary business activities before the impact of financing, accounting, and tax decisions. By looking at EBITDA, investors can get a broad sense of a company's profit potential without being as influenced by these other factors. There are several advantages to using EBITDA when analyzing a company. Firstly, by removing non-operating expenses, EBITDA helps investors focus on how profitable a company is from its main business activities and the cash profits it generates from those operations. Secondly, because it excludes interest expense, it allows for a more direct comparison of companies with different levels of debt or capital structures. Similarly, by excluding taxes, it helps in comparing companies that operate in different tax jurisdictions or have different tax rates. Furthermore, EBITDA is useful for comparing companies with different levels of capital investment and depreciation policies. This is especially helpful when comparing companies within the same industry but with different asset bases or accounting practices. Thirdly, while it's not a direct measure of cash flow, as depreciation and amortization are non-cash expenses, EBITDA can serve as a proxy for the cash flow available from operations to service debt and fund capital expenditures. However, it's also important to be aware of the disadvantages of using EBITDA. One significant drawback is that it does not reflect the cash needed for capital expenditures. EBITDA ignores the money a company has to spend to maintain and grow its business by investing in assets like equipment and technology. Another disadvantage is that EBITDA ignores the cost of debt, which is the interest expense a company pays on its borrowings. For companies with significant debt, this can be a substantial expense, and EBITDA can paint an overly optimistic picture of their financial health by not taking it into account. EBITDA also doesn't account for taxes, which are a real cash outflow for any profitable company. Tax obligations can significantly impact a company's overall profitability and cash flow. Because it excludes these real expenses, EBITDA can be misleading for companies with significant debt or capital investments. It can make asset-heavy companies appear more profitable than they actually are by not considering the ongoing need to invest in and replace those assets. Finally, it's important to remember that EBITDA is not a recognized accounting standard under generally accepted accounting principles, or GAAP. This means that its calculation can vary between companies, and it's not always consistently reported, which can make comparisons less reliable at times. The Securities and Exchange Commission, or SEC, actually requires public companies that report EBITDA to also reconcile it with net income, highlighting its non-GAAP status. Watch our other videos to learn more about EBITDA.